Hello everyone, this is Jordan. This video is being recorded on the late morning of Tuesday, July 16th, 2024. Thank you so much for tuning in. In this video, just going to talk about what could be driving gold right now and also the warning signal that is approaching code red for both the economy and the stock market. So let's get right into it. So first things first, wasn't planning on talking about gold much. I'll do another video on gold, but this is the up-to-date daily chart on gold, and this is what's happening today. So you have a clear breakout from, I don't want to say it's an unconventional flag, but you have this big move like this here in two pieces, but this is clearly somewhat of a flag. And as I said in my last video, you have measured upside targets pointing to at least 2720 or so. If you measure this entire thing from here as the flag, which is possible, that's a little over $400. So that potentially gives you a flag breakout target of 2,900. And of course, the cup and handle target going back 13 years, the minimum upside for that is about 2,900, 3,000. Then you have the log target, which, as I explained in my study of these major cup and handle patterns, you have the measured upside target, and then the log target tends to be reached 6 to 12 months after the measured upside target. So very exciting for gold if this move continues, and if it is to hit 2,900 or 3,000 in the next, call it 3 to 6, 7 months or so, then you can add another 6 to 12 months on top of that for a potential move to 4,000, the log target. But this isn't really the focus of today's video. We're talking about the yield curve and, of course, what is happening in the bond market and with interest rates. And we know that, or the Fed, I should say, and we know that Fed easing is coming. The market has now priced in a rate cut in September. That's 100% priced in. I know that it's priced in a little bit more as far as rate cuts, but I haven't looked at that, so I'm not completely updated on that. But so there's a lot to take in on this chart. And we have here's the Fed funds rate. There's two yield curves. This is the 10-year minus the 2-year, the conventional. This is the 30-year minus the 2-year, which at times has led this yield curve. Then you have the stock market gold against the stock market here. And there's just a couple important things I want to point out. Of course, first, the most important thing to keep an eye on is the steepening in the yield curve. So this has not updated yet today, but as of yesterday, we have the 10-year minus the 2-year. This is creeping up to steepen above zero. And of course, when the thing that we're all looking for is the yield curves are inverted, then when they steepen and rise above zero, that's your recession bear market signal. So that is what the warning is. We're getting dangerously close to that. And if you look at the 30-year minus the 2-year, if you look at here and here, and also here, you didn't have an inversion here, but this started to steepen before this curve, and the same thing happened here and here. So the 30-year minus the 2-year, this one tends to lead the conventional 10-year minus the 2-year, and so we can see here again, this is very close to steepening above zero. It closed yesterday at zero. So this is on the brink, and so I expect over the weeks and next few months that this will steepen above zero, and then this will follow. And we can see that when that happens, as I've show here with these vertical lines, you tend to get rate cuts when that happens. So very close to steepening, or maybe it started to steepen. Rate cuts are coming, and that also, in these three instances, that correlates with a top in the stock market. Now, what's interesting is the top in the stock market in 2007 actually peaked after the steepening began. And the same thing happened here. The 87 to 90 period was a little weird, but you had the steepening really begin in 89, but the S&P didn't peak until 1990. So it is possible that we get the steepening, but the stock market, maybe it has a mini blow-off coming and doesn't peak until several months after the steepening really begins. Now, one other important point that I want to point out is gold outperforming the stock market. We can see here This tends to not really begin until you get the steepening. Here we see it didn't really begin until 2001 or the middle of 2001. Here, again, it was late 2007 when this really started to begin. Here, this began after, you had the rate cuts here in the middle of 2019. Then you had COVID and the rate cuts to zero again here. So here we are again where gold against the stock market has struggled. But the good news is we can see here in history that gold doesn't really outperform the stock market until the steepening begins and you get the rate cuts. So what that tells us is that when we get this steepening, which may be just starting, when we get these moves above zero, more rate cuts, this should start to move like that. And as I have talked about in other videos, when we get this move, this is going to be so powerful for the bull market in precious metals. That is going to be extremely significant. I can't understate it enough. You're probably sick of me talking about it. But this is what we'll be looking for in the coming months, presuming we get this move here and we get the steepening. So that's where we are. It could be very exciting for gold and precious metals, or I should say should be very exciting in the second half of the year. So if you haven't already, check out thedailygold.com/premium. That's my premium service. Talked about it a little bit in past videos. I won't repeat that in this video, but if you want to know the stocks that I'm investing in that I think have 5x, 10x potential, go to thedailygold.com/premium. Would love to have you. Thank you so much for following this video. Hope you're having a great day. Leave a comment. Let me know what you think, and I'll talk to you guys again in the next video.